The headlines are clear.
Said that everything's going to be okay, and they're just not now.
Two-class society.
Bad news this morning for potential home buyers.
Buying a home, it's getting tougher. But amidst the noise, there is a tool, a scheme designed to give you an edge in the uphill battle. Let's dive into the First Home Super Saver Scheme. At its core, the First Home Super Saver Scheme is like a saving amplifier. Here's how it works. You can voluntarily direct up to $50,000 into your superannuation, specifically for your first home. Outside the super world, that saving could be taxed up to 45%, depending on your tax bracket. But in your super, that tax rate drops to 15%, which is generally lower than most people's tax bracket. To put that into perspective, meet Melanie. She's earning $60,000 annually, so her current marginal tax rate is 32.5%. If Melina decides to invest $10,000 per year outside her super and into a term facility, she's looking at after-tax saving of $6,441. After 3 years, that's around $19,500. If Melanie's salary sacrificed at $10,000 to super, per year, she'll be looking at after-tax saving of $8,500. After 3 years, that's over $25,000. That's a tangible difference of $6,239, staying right in her pocket simply by choosing to save within her super. Now, the most frequently asked question we get on this is, what about tax on the way out? Like most super savers, tax is payable on the way out. But when it comes to withdrawing the First Home Super Saver savings, there's a 30% tax offset. This means that Melanie releases or withdraws her contributions, she'll be taxed at her marginal rate of 32.5%, plus Medicare levies, which is 2%, less a 30% tax offset. So in total, she will pay another 2.5% tax when she withdraws her savings, plus an earnings as calculated by the ATO. To jump in, you need to meet a few eligible criteria. First up, you need to be over 18. You can't have owned an Australian property before. And when you finally buy the property, you will need to move in as soon as possible, or at least within 6 months of the 12 months you own it. And like every good thing, the scheme has its limits. You can only use the scheme once, which means you can only make one withdrawal from your super to use as a deposit for your home. There is also a cap on your contributions. You can only contribute $15,000 per year, and a lifetime maximum you can save through the scheme is $50,000. This means even if you make involuntary contributions of more than $15,000 in a year, only $15,000 can be counted towards this scheme. And once you reach the $50,000, you can still make voluntary contributions, but they won't count towards the scheme. These contributions, plus any others you or your employer makes, must fall within the annual contribution limits for the year, which for 2023 is $27,500 concessional contributions and $110,000 for non-concessional contributions. To access the funds, you will need to apply to the ATO to withdraw contributions, which can be done using your MyGov account. The ATO will advise superfund providers of the amount that can be released, and you'll receive a determination from the ATO which will tell you how much you can withdraw. One thing you have to keep in mind is that you have 12 months to sign a contract to purchase or build a home once you've accessed the First Home Super Saver contributions. If you don't, you can either apply for an extension of 12 months from the ATO, recontribute the money to your super, or keep the money, but then it will be subject to an additional flat tax rate of 20%. And of course, you also have to keep in mind that every strategy has its highs and lows. On the upside, you're looking at a tangible tax saving, potential reductions in taxable income, and a structured saving path. But the downside, there's more bureaucracy, your funds aren't as liquid as in the bank, and not all contributions can be withdrawn. The First Home Super Saver can be a great tool and strategy to help you buy a property in the current market. But like any strategy, you need to know the ins and outs. So speak to your accountant and tax agent before you make any decisions. If you found this video useful, please like and subscribe and share it with your mates. See you next time.